The moving average cross indicator is a powerful technical analysis tool used by traders. This indicator involves plotting two moving averages of different time periods on a price chart and watching for crossovers. Let's examine a typical price chart where we'll apply moving averages. The short-term moving average, typically calculated over 10, 20, or 50 periods, responds quickly to price changes. The long-term moving average, often calculated over 100 or 200 periods, moves more slowly and represents the longer-term trend. When the shorter-term MA crosses above the longer-term MA, it generates a bullish signal known as a golden cross. Conversely, when the shorter-term MA crosses below the longer-term MA, it creates a bearish signal called a death cross. The moving average cross indicator is a versatile tool that identifies potential trend changes through crossovers, providing traders with bullish and bearish signals across various financial markets. In trading analysis, there are several types of moving averages that can be used in moving average cross strategies. The simple moving average, or SMA, gives equal weight to all price points in the calculation period. It's calculated by summing the prices over a specific period and then dividing by the number of periods. The exponential moving average, or EMA, gives more weight to recent prices, making it more responsive to new information. The EMA uses a multiplier that applies more weight to the current price, allowing it to respond faster to price changes. The weighted moving average assigns weights linearly, with the most recent price getting the highest weight. It's less sensitive than the EMA, but more responsive than the SMA, providing a middle ground in terms of reactivity. The smoothed moving average is a modified EMA that provides more smoothing by taking into account all available data. It reduces noise in the price data and can provide clearer signals with fewer false alerts. When comparing these moving averages, we can see that they have different responsiveness to price changes. The EMA reacts quickest to price changes, followed by the WMA, then the SMA, with the SMMA being the slowest to respond. This responsiveness affects how quickly crossovers occur, with more responsive moving averages generating signals earlier, but potentially with more false signals. The golden cross is one of the most significant technical patterns in market analysis. It occurs when a shorter-term moving average crosses above a longer-term moving average. Let's visualize how a golden cross forms. First, we have a market in a downtrend. As market sentiment improves, price action begins to turn upward. The faster 50-day SMA responds more quickly to this change. The golden cross occurs when the 50-day SMA crosses above the 200-day SMA. This critical moment is considered a powerful bullish signal. The most significant golden cross is when the 50-day SMA crosses above the 200-day SMA, often signaling a long-term bull market. This pattern typically forms after a market has been in a downtrend and suggests a potential reversal to an uptrend. For traders, a golden cross often prompts considering buy positions. However, it's best used in conjunction with other technical indicators for confirmation. The death cross is the opposite of the golden cross. It occurs when a shorter-term moving average crosses below a longer-term moving average. This technical pattern involves the 50-day simple moving average crossing below the 200-day simple moving average. The death cross is interpreted as a bearish signal, suggesting downward momentum and potentially marking the beginning of a bear market. Let's take a closer look at what happens during a death cross formation. This pattern typically forms after an uptrend has ended. When traders see a death cross, they may prepare for potential downside or consider selling positions. Moving average crossovers can generate false signals, especially in choppy or sideways markets. When price moves sideways without a clear trend, moving averages can frequently cross, creating misleading trade signals. Here we can see multiple crossovers that would have resulted in false signals and likely losing trades. To reduce false signals, traders use several confirmation methods. First, volume analysis. Higher volume during crossovers adds credibility to the signal, suggesting stronger market conviction. Second, wait for price confirmation by requiring the price to close beyond the crossover point before taking action. Third, use additional technical indicators like RSI or MACD to confirm the potential trend change. Finally, implement a time filter, requiring the crossover to remain intact for several periods, which helps filter out temporary noise. When these confirmation methods are applied, traders can significantly improve their results by avoiding false signals. As seen in this comparison, using proper confirmation techniques allows traders to avoid false signals and only take higher probability trades. By combining moving average crossovers with these confirmation techniques, traders can develop more robust trading systems that are less susceptible to market noise. The time frame you choose for moving average cross analysis significantly impacts both reliability and trading frequency. Longer time frames, like daily and weekly charts, typically produce more reliable signals but offer fewer trading opportunities. Notice how the moving averages on the daily chart produce smoother, clearer crossover signals with less noise. In contrast, shorter time frames such as hourly or 15-minute charts generate more frequent signals but with lower reliability due to increased market noise. Let's examine how different time frames compare in terms of signal reliability and frequency, and which trading styles they best support. Weekly charts offer the highest reliability but very few signals, making them suitable for position trading with longer holding periods. Daily charts balance good reliability with a reasonable number of signals, ideal for swing traders looking for multi-day moves. Hourly charts provide a middle ground, used primarily by day traders who close positions by the end of the session. Short time frames like 15-minute charts generate many signals, but with higher false signal rates, suited for scalpers seeking quick in-and-out trades. Many experienced traders use multi-timeframe analysis to gain a more comprehensive market view. This approach allows you to confirm signals from higher timeframes, identify better entry points, filter out false signals, understand market context, and balance reliability with trading opportunities. The key takeaway is to match your time frame to your trading style and goals. Consider using higher time frames for overall market direction, while using lower time frames to fine-tune your entries and exits. Most popular trading platforms allow easy setup of moving average cross indicators. Let's look at how to set up the MA cross indicator on a platform like TradingView. First, navigate to the Indicators section and select Moving Averages. Add your first moving average with a shorter period, typically 50 days, and choose a green color for better visualization. After adding the first moving average, you'll see it appear on your chart. Next, add a second moving average with a longer period, typically 200 days, using a red color. With both moving averages added, you can now see the crossover points that form the MA cross indicator. Many platforms also allow you to set up alerts for when the moving averages cross. This way, you'll be notified of potential trading opportunities. To summarize, setting up an MA cross indicator involves adding two moving averages with different periods, using contrasting colors, and optionally setting up alerts for crossover events.